Every landlord you've ever met has a secret, and that secret is quietly bleeding you dry every single tax season. We're talking about a silent wealth transfer happening in plain sight, one that costs real estate investors thousands, sometimes tens of thousands of dollars every single. The IRS tax code is basically a choose-your-own-adventure book, except most landlords never flip past the first page. If you're only claiming basic expenses and calling it a day, you're essentially leaving a pile of money on the table and walking away with a smile. Here's the catalyst. Depreciation is the most underused, misunderstood tool in the landlord's arsenal, and almost nobody talks about it at dinner parties. Your residential rental property can be depreciated over 27.5 years, which means you get a deduction every single year just for owning the thing, even if it's appreciating in value. And it gets more interesting. There's something called cost segregation, where an engineer breaks your property into individual components and accelerates those deductions. A fence, a parking lot, appliances, these don't depreciate over 27.5 years. Some of them can be written off in as little as 5. Remember 2018 when the Tax Cuts and Jobs Act dropped and everyone was buzzing about bonus depreciation up to 100% in the first year? That window has been closing. And if you blinked, you might have missed the freight train of write-offs that was legally available to you. The psychological trap most landlords fall into is that they assume their CPA has it handled. And look, maybe they do, but not all CPAs specialize in real estate, and a general practitioner is not the same as a specialist surgeon. Relying on a generalist for your rental portfolio is like bringing a butter knife to a cost segregation study. Historically, tax law has always favored capital, and real estate specifically has enjoyed preferential treatment dating back decades because governments genuinely want private citizens building housing stock. The insider community, the real estate forums, the syndication groups, they've been whispering about these strategies forever, while the average landlord pays full freight. One of the biggest misconceptions is that these advanced strategies are only for big commercial players or multifamily syndicators with fancy lawyers on retainer. A duplex owner in Ohio can hire a cost segregation firm, run a study, and potentially unlock tens of thousands in accelerated deductions. This is not exclusive to the ultra-wealthy. There's also the often overlooked deduction for home office use, vehicle mileage for property visits, professional development, subscriptions, and even travel to inspect out-of-state properties. These are ordinary legal deductions that the tax code explicitly allows, and yet landlords skip them because they feel too small or too risky to claim. The practical lesson from every market cycle is this: the investors who consistently win aren't necessarily the ones who buy the best deals. They're the ones who manage their tax liability with the same rigor they manage their rent rolls. A property that cash flows $300 a month looks very different when tax strategy adds another $200 in effective monthly savings through deductions. Don't swing for the fences and start inventing deductions or playing games. That's how you end up in an audit, sweating through a very uncomfortable conversation with someone who works for the government. The disciplined move is systematic, documented, and boring. Track every receipt, categorize every expense, and work with a real estate specialized CPA who lives and breathes Schedule E. The irony is that the tax code was literally written with incentives to encourage landlords to provide housing, maintain properties, and take on risk. And yet the people it was designed to reward are the ones least likely to fully claim what's theirs. That's not a conspiracy. That's just the gap between complexity and awareness, and now you're on the right side of it. Discipline, position sizing, and consistency aren't just investing principles, they apply to your tax strategy too. Because a leaky tax plan erodes returns just as surely as a leaky roof erodes your property. You can be comfortable with any market outcome when you know your fundamentals are locked in and your after-tax numbers actually make sense. If you've been overpaying, don't spiral, just start asking better questions of your accountant, request a cost segregation analysis, and audit your own deductions before the IRS ever gets curious. The money you've been overpaying isn't gone forever if you act with intention, and in some cases, amended returns can recover prior year overpayments going back 3 years. Whether you're a seasoned landlord or just getting started, we can help you build the right foundation. Check out our links in the description below for resources on real estate investing, home contracting, work, and connecting with lenders who actually understand what you're building.